Welcome back, guys and gals. JJ here once again, schooltrade.com. It is great to be back with you guys and gals. Another psychology lesson. I got a question for you. Can we use any indicators to help with our emotions? Can we use any technical indicators out there to help keep that positive mindset that we talk about in these psychology lessons? You know, most traders use indicators, technical indicators, to find trading opportunities. But can those same technical tools be used to help our psychology? In today's psychology lesson, I'm going to give you an introduction to an effective strategy that uses indicators to help with our emotions. But before I go into today's lesson, I want to remind you guys, make sure you subscribe to our YouTube channel and make sure you adjust the settings in YouTube to alert you every time I post a new video. And if you really want to stay in tune with everything that is School of Trade, make sure you go to the website at schooltrade.com. I'll put a link in the description of the video and join our mailing list. Guys, question of the day today, topic of the day today, can we use any indicators to help with our emotions? Before I answer that question though, I want to take a moment to remind everyone, and myself included, that a successful trading career is all about keeping a positive mindset. And a positive mindset is a direct result of aligning our expectations properly with reality. Let me give you an example of how I've made this mistake of having expectations that were out of line, right, with the markets. One of the most common mistakes that I made while learning how to trade was trying to use a stop loss that was too small for the market time frame that I was trading. You know, I would find a good entry pattern, I would take the trade, I'd place my stop loss, place my targets, but the volatility in the market was too much for my small stop loss to hold, and I would get stopped out of the trade just to watch the price reverse and go straight to my target. If you've ever experienced that, you know it's a pretty frustrating experience, right? Especially for a new trader who hasn't quite got the rhythm of things yet. Now, another problem I ran into when I was learning was that I would find a good entry pattern, I would take the trade, I'd place my target, and watch the trade go in my direction almost up to my target and then miss it by a few ticks and then crash back down and stop me out for a loss. What's happening in both of these examples? In the first example, my stop loss was too small for the amount of volatility that was in the market at that time. That caused me to get shaken out of good trades too early and missing targets on trades that were successful. In the second example, right, my targets were too large, right, for the volatility in the market. So I wasn't able to capture that profit, right? So two examples, one too small, one too large. Have you ever had that experience before? If you have, you know it's really frustrating for a new trader. And now, what does that experience do to your mindset? Think about it for a moment. Missing those targets, getting shaken out of good trades, what does that do for our mindset? Are we able to keep a positive mindset after a week or two of losing money like that? If you're like most people, probably not. Most people would have a negative view of the market when they keep missing targets or getting shaken out of profitable trades, saying the market makers are out to get me, or the classic, right? They keep running my stops, right? It definitely feels like they're out to get you, but an experienced trader knows much better. An experienced trader knows the market isn't out to get you. The market's not running your stop, right? The market doesn't even know we exist. It doesn't care about us, right? We just aren't aligning our expectations with the reality of the market that we're trading. So if we all agree that a successful trading career requires a positive mindset, can we also agree that our trading strategy, and more importantly, the tools we use in that strategy, could have a direct impact on the quality of our mindset? And in turn, could those tools help our level of success? I would think so, right? I would think the tools that we're using can help better our mindset. And by having a better mindset, right, positive, optimistic mindset, we will be better traders. So what trading tools are available, right, on most charting platforms that would help us align our expectations so that we can achieve a more positive mindset and in turn more positive results? You know, I can think of two technical indicators that I use every day which help align my expectations, and they are volume and average to range. Now let's talk about volume first. Everybody knows about volume, right? Volume is pretty common, but here's the way I like to use it. Volume is a simple tool. Again, almost everybody knows about volume. It measures the number of contracts or shares, right, traded at any given time of the day. Now, some people use volume on a per candle basis, right? Such as like a 5-minute chart with a volume indicator at the bottom. Whereas other traders like me, I like to use the volume at specific times of the day. For example, one of the first things I do every morning when I open up my trade room at 8 o'clock Eastern time with all of our advanced members is I look at the total volume count coming out of the overnight London session. I started tracking the total volume count each morning, and I created an average for each market I want to trade. Once I know the average volume count that we see at 8 o'clock every morning, Monday through Friday, then I can compare each new day with the average volume. It's pretty simple. I know, for example, that crude oil should have around 125,000 contracts at 8 o'clock Eastern time. And if it doesn't, then I know the market is either waiting for something, or maybe there's news coming out, or maybe it's rollover like we saw right on Friday. And then I need to stay patient, or maybe not trade that market at all. So if I come out at 8 o'clock Eastern time and we are below the average that I've seen at 8 o'clock Eastern time, I know something has changed and I need to investigate and figure out what has changed and then make small adjustments from there, adjusting right my expectations. But if I come in at 8 o'clock Eastern time tomorrow morning and crude oil has traded over 200,000 contracts overnight, now I know this market is reacting to something. And I need to be prepared for the U.S. session traders, right, to enter the market on the next pullback because they won't want to miss that opportunity, right? Very simple. If volume is greater than the average, I know something's going on, and when the U.S. session traders come in, I know they're going to want to jump on it, and I don't want to miss that opportunity. The opposite, right, is true as well. If the volume is under the average, I know we're waiting on something, and I need to explore more to figure out what they're waiting for, and then make adjustments from there. So volume is a great example of a technical indicator that helps me align my expectations so that I can maintain a positive mindset that's needed for a successful career. But I got to be honest, I got one more indicator that's even more important to me, and that's the average true range. You know, a number of years ago, I learned how to use the average true range indicator. It's also known as the ATR. The ATR is a real simple tool that measures volatility over a specific period of time. And most traders use a 14-period ATR. Now, I'll put a link below the text, in the text of this video, right? If you want to learn how this tool's calculated, it's a little bit complex, but keeping it simple, ATR, average true range, allows me to align my expectations with the volatility in the market at that specific time of the session. Now, do you recall that example from earlier? Remember how my trades kept getting stopped out too early, or I would miss a target because my targets were too wide? Both of those problems come from not aligning my trade management to the specific market's volatility at that specific time. And I can use the ATR indicator in two ways to help prevent that mistake. The first way I can use the ATR indicator is on a daily chart. Open up a daily chart. I recommend a 1440 minute, not an actual daily chart. Daily data is not very reliable data. So open up a 1440 minute, 1440, right? 1440 minute chart, and put a 14 ATR, your default ATR indicator, right on that chart. What that will do is that will tell you the average days range over the past 14 days. So if crude oil, for example, has an average range of 125 ticks, right, $1.25 over the past 14 days, I know that I can look for wide targets up until we exceed 125 ticks. If we see a situation where crude has moved 150 ticks and the average range is 125, then I want to start thinking about either keeping those targets relatively tight, or was there some big news that came out that would warrant expanding that range? So that's one way I like to use ATR. Now, another way that I like to use the ATR indicator is to apply it to our specific trading time frame. For example, I like to use a 1,000 volume chart to trade crude oil, and I'll use the ATR indicator to tell me when the average range over the last 14 candlesticks exceeds 10 ticks. I like to use a 10-tick stop loss day trading crude oil, so I can use the ATR indicator to tell me when the averages are too high. And I can use that information to avoid trading during times when the market is too volatile. Remember, everyone has a personal risk tolerance, right? Personal kind of tolerance for risk. If my comfort zone on crude oil is a 10-tick stop, which I think is the best personally, I want to use the ATR indicator to identify the times when I can trade safely, right, using that 10-tick stop. When times get too volatile, i.e. when the ATR is above 10, then I can sit on hands and wait for the market to come back within my comfort zone again. Boy, we've covered a lot of information today in a very short period of time. Let's do a quick recap, shall we? Today, we were reminded that a successful trading career is all about keeping a positive mindset. And a positive mindset is a direct result of aligning our expectations with reality. When we align our expectations, trading is easier, it's more enjoyable, it's more profitable, and it doesn't feel like the market's out to get us. I've talked about 2 technical indicators that I use every day, which help align my expectations, and they are volume and average to range. I use volume to create an average at 8 o'clock Eastern time, and each morning I compare the day's volume with the average, which helps me get a finger on the pulse of the market's personality coming out of London. I can then align my expectations with the market much more effectively that way. My favorite tool, however, is the average to range indicator, and I use this in 2 ways. First, I use it on a daily chart to give me an idea of the average daily range for the last 14 days. With that information, I then know when I can be more aggressive with my targets and when I need to be more conservative. The second way to use the average to range is to apply it to my trading time frame, such as a 1,000 volume chart. When I see the ATR exceeds my personal risk tolerance on that 1,000 volume chart, I choose to sit on hands so my stops don't get shaken out of good trades. When the ATR is within my risk profile, then I know I can safely use a small stop loss without the risk of getting whipped out of my trades or missing, right, those targets. Now, guys, I should also remind you that I teach all of this stuff every morning in my trade room, so check out my trade room over at schooloftrade.com. I look forward to helping you align your expectations by being a professional coach with a professional trading strategy that seeks to trade with the market, not against it. Because that's the only way you're going to get real long-term results in the business of day trading. Wrapping things up, boy, that time flies. I've taken up way too much time here of you guys this afternoon. I hope you found a ton of value in today's psychology lesson. I would love to hear from you about additional topics you'd like to see me cover in my next psychology video. If you love the video today, give me a thumbs up, subscribe to the channel, share with a friend of yours, right? And make sure you remember, check me out on my free trial at schooloftrade.com. I'm always working hard with all of our clients here at School of Trade every morning, Monday through Friday, 8 o'clock Eastern time in our trade room. Check out our nightly newsletter, right? And I look forward to seeing you guys on our next psychology lesson. My name is Joseph James. Be well out there. Be nice to each other, will you? And be here next time. Adios, amigos. Bye-bye for now.